thank you everyone for coming here. I know it's getting late in the evening, so you can see some shoulders drooping. Let's wake you up. We have an awesome panel here of some fantastic investors, venture capitalists. And we have Nakul, we have Salil, we have Jay. They'll give a brief intro about themselves. And after that, I would love you all to take this opportunity to grill them. I'm sure there's tons of folks right here in this room which have gone to a VC for funding or for some other thing and had maybe good or maybe not as good experience. So we want to have a lot of Q&As. They're very sporting. They said we're ready to take all the questions. So here's your chance. Make the most of it.
Only Salil did.
Only Salil did? Okay. So why don't we get started with the introductions, please?
Hi, I'm Nakul. I'm a partner with Lightspeed Venture Partners. I focus on SaaS applications, so enterprise primarily. And I've been doing this for 10 years now. Last 7 years here in the Valley, first 3 years in India, where I was doing growth investing. And yeah, so that's my quick background.
I'm Salil Deshpande. I'm managing director at Bain Capital Ventures. I've been a venture investor for 10 years now. Before that, I was an entrepreneur, mostly in the middleware space. And before that, I was an engineer.
Hi, I'm Jay Das. I'm one of the MDs at Sapphire Ventures. We are more enterprise-oriented investors, and I kind of invest up and down the stack, although, excuse me, do mostly around the infrastructure and a little bit around mobile payments. And then by background, I've been investing for almost 15 years now, and I started out as an engineer at Oracle a long time ago.
So just as a show of hands, are there entrepreneurs here which are from India or who are looking to invest or looking for VC funding in their Indian companies or around or outside the US? Can we get a show of hands? Yeah. There are a few on those lines. So Jay, maybe we can start with you. And sure. I can see that lovely smile on your face now. So you have a bit of experience with the India-US space. Right. So are you, is the same yardstick used when you're going to India and things? And what's your experience been?
Yeah. So, with full disclosure, we invested in India from, I think, 2007 to about 2011. And then we have decided not to invest anymore in, companies in India made out of, kind of either an Indian entity or a Singapore entity or a Mauritius entity, right? And there are a couple of things, and you'll see a lot of the funds similar to us. Is one, it is very hard to manage kind of the return expectations and IRR expectations between a US fund with US kind of returns and IRRs versus an Indian fund where the returns and IRRs are very different. So if you have seen most of the funds that are still operating, like Sequoia and Excel, and even I think Lightspeed, right? They're all independent funds. They don't invest out of the same pool of capital. And we decided not to go and raise an India-focused fund only. The two, for us, what has happened is that we do more enterprise-oriented investments, and most of those investments, what we find, the good ones, all end up in the Valley. There's 3 or 4 of them that have gotten funded that started in India, but pretty quickly moved to the US. Including Apogee, which actually, I don't know if people know, was one of the first product-oriented company that started out in India, in Hyderabad, actually. And then rapidly came out here. So it is very hard to do enterprise-oriented kind of investments. And then, and the last thing is that, in India, exits has still been a challenge. If you look at it, the exits on the internet side have been very few IPOs, right? You can count Make My Trip and Just Dial, and after that, there really hasn't been any other exits. So because of all of that reasons, we've kind of decided not to do that.
Okay. Anybody want to add?
Yeah, I think when you talk about investing in India, you have to divide it into 2 buckets, whether you're going after the US market or whether you're going after a non-US market, perhaps the Indian market. And I think there are a lot of companies in India where the R&D groups, what ends up being the R&D group remains in India, and sales and marketing and general management has to be here because the market is here.
Yeah. Yeah.
Yeah, I'd just add, so I agree, investing in enterprise companies that are headquartered in India, the CEO being based there, head of sales being based there, that's, I think, really tough. In my mind, I think the market opportunity in India exists simply because of the size of the GDP has gotten to a point where it's a massive economy. And pure play companies that are addressing India's domestic problems will come out. I think exits have still been lacking. But the reality is, I have experience through two firms, right? I joined Battery actually in the India office. The reason I'm here is because they shut down that office, and we came here. Similar to what Jay is saying, that so we had 4 companies there. We wanted to continue investing in product companies. This was 2009. And in 2009, there were hardly any product companies in India. And so we backed out of that market. Lightspeed, on the other hand, was hardly investing much. And if somebody was sitting in India in 2009, they would have looked at Sequoia, Norwest, and others who were kind of becoming more growth investors there, and that was fine for this strategy, and would have looked at Lightspeed and said they're not investing much, but they're sitting here, right? But now we are finding more product companies coming out of there. So I think it's an evolving market. I think if you believe that in the next 2 decades it will continue to evolve into a product country, then I think it still makes sense to be based there. But you have to find companies that are addressing India's domestic problems and think on first principles, not, I think, copy US-based ideas.
Yeah, okay. So let's get back here. And we have Salil here with the Midas Touch 2013, 14, 15, 16. So are you responsible for this valuation bubble which is going on?
Yes, I am.
Okay. And how do you plan exits with this bubble? Anyways, yeah, go ahead. Yeah.
What's the question?
The bubble?
Is there a bubble? Is there a bubble?
Yeah, is there a bubble?
Yeah, I think there's a bubble more so in growth stage or late stage private companies. The public companies have adjusted mostly, and early stage there is still a bubble, but it affects people less because instead of 8 pre-valuation, if you do a 16 pre-valuation, it doesn't really break anything. So we are handling the bubble by going earlier and earlier. So I do primarily early stage and primarily infrastructure. I didn't say that earlier. And infrastructure is generally the last category to get affected by the bubble. Now, we're not going early just to avoid the bubble. That's part of a larger strategy. But when you see valuations that you don't think are reasonable, then you just don't do those deals, and you do deals that you do think are reasonable, and they end up being a little earlier.
Okay. And do you see? I mean, is there more reasonable valuations or expectations from entrepreneurs coming in? Is there a market correction going on as of now, or for the last 6 months, 1 year? We keep hearing about it. So.
Yeah, absolutely. I think deals are taking, first of all, I think it's a more constructive environment. Deals are taking longer to happen, which helps both sides, I think. There was a bit of a frenzy in 2015 and 2014. We didn't have time to do due diligence. There were often bidding wars, and that feels good for the entrepreneur at the time, but it ends up not really being good for him in the long term. So I think it's better now. The expectations are more reasonable. There's more time to do work. Companies are still raising money. Funds are still making investments. So I think it's good.
I will say that, though, there is a big haves and have-nots that's happened, right? So if you have a company that has really great metrics, has a great market that they're addressing, and the management team has done this a couple of times, you will get 4 or 5 term sheets, and will get bid up, right? Yeah, it'll take a little longer. People will do more work. People are aware of it. But capital for those companies are there. So it's almost like, on the other hand, if you have a little bit of hair in your metrics, or your CAC ratios for a SaaS company is not the pristine, above a certain thing that investors are looking for, then you're in for a long haul to kind of basically be there and showing the potential investors that, yeah, you're kind of correcting all of those issues before they will jump in. So there is definitely, before the same companies maybe 12 months ago would have no problems raising money and, would probably have 3-4 term sheets. So that has changed. But there is enough capital that for the really good companies, yeah, maybe they, the entrepreneur thought they would get $1 billion, they're getting, whatever, or maybe 200, they're getting 150. But the capital is still there for the really good companies.
So that brings out an interesting question, is you're looking for, you have entrepreneurs who have done it successfully 3-4 times. So where is the risk now? I mean, you are the venture capitalists, so is there really risk behind these kind of things?
I actually don't necessarily look for entrepreneurs that have done it 3 or 4 times. Most of my investments are first-time entrepreneurs.
Okay.
The entrepreneurs that have done it 3 or 4 times, one, they know a lot of VCs already. A lot of VCs know them, and they can raise money with just a PowerPoint, without product, without validation. And that's fine, that's good for them, but it's not always a good deal for the VC.
Valuation in the early stage goes up.
Yeah, I have the same view that I prefer first or second-time founders. And I think also, if you did a very successful company, let's say in 2003, the product market landscape in 2003 and 2016 is just fundamentally different. So yes, you might know how to build a company, and there are definitely lessons on when to hire a first VP of sales or how to handle team issues. But at the earliest stages where some of us are investing, seed, Series A, maybe sometimes Series B, like the key question is, can you get product market fit? And you want a person who's in line with, who's been in the enterprise world, let's say, at Salesforce as a young, hungry exec, and been at the forefront of those changes, and seeing the macro trends come together and saying, this is why this gap exists. And sometimes that's difficult if you're too senior. So I actually prefer early on.
So from this change topic, so from an investment perspective, what kind of space are you looking at? Applications, infrastructure, what do you look for in a good company or a good deal? So what clicks for you guys?
So I focus on application markets. The way I think about it right now, and obviously these things also evolve every couple of years. In general, I think we are seeing a complete, like the first generation of SaaS opportunities, the greenfield opportunities where you were either replacing on-prem software with cloud-based software, that has already played out, right? And there has been also a good number of vertical SaaS plays where greenfield opportunities were attacked because the go-to-market model became simpler because of SaaS and stuff. So I think the next-gen software for me is all about data-driven and intelligent software. And what that means for me, at least, is if you're a sales rep, the software will recommend an action to you rather than just log your workflow, right? If you're a recruiter, the software will recommend that these are the people to focus on for hiring. Likewise in other functional areas. So I think of it as more data-driven, intelligent software. It could be in verticals like finance or healthcare or horizontal areas. So that's how I think of it.
Yeah, I focus on infrastructure software, which to me means everything behind the firewall and in front of storage. So I don't do security, I don't do storage. But everything in between, that includes databases, caching, application performance management, developer tools, platforms, DevOps. And because I focus mostly early, it means I relate to engineers. So generally, I'm looking for the 2 or 3 person team that's very strong in engineering and creativity, and then everything else can be added later. So I don't need to see a business guy there necessarily, as long as there's a person who is in tune with the market and can get the product market fit right. Doesn't have to have a sales leader or marketing leader at the outset. And I focus a lot on open source, which means you already have the market validation, because often the open source project is out there and people are using it. You can see what people are doing with it. So if you have a strong engineering team and market validation, it's the best of all worlds. You just later have to figure out how to monetize it, which can be difficult, but it's doable.
so I'll be a little flippant. So we focus anything that we can make money on, and and the reason I say that is
I like your strategy, man.
but there is a degree of truth to that. We are a little bit of a later stage investor, so we kind of go in once there is a product is done, and there's product market fit. And so we look a lot at sales efficiency, what is your strategy to go to market, how efficient is it, how much money do you need to actually get to the point where you can kind of dominate the market and things like that. We of course look at team and the market size, and the product and all of that stuff. But fundamentally, what things we have found is that by the time we come in at a Series C, Series D kind of level, if the metrics are really good, for a company, typically there's an 80% chance that the metrics will keep being good, and then it will be a really big successful company. Or if the metrics are not that great, it's only a 20% chance that it'll get better, and that you'll be a very great successful company. So we do a lot of financial analysis, and the other thing we do is we talk to our CIOs. We have a large CIO advisory council, and we kind of use them as a way to understand what their pain points are. Because we are not smart enough, like the early stage guys here, to understand, hey, what are the trends where we should invest? So the CIOs tell us a lot about, hey, this is what we like. One of the things we found was that Azure is kind of coming up as fast as AWS now in the enterprise, right? So we kind of started looking at some investments around that. So that's kind of our hunting ground, that the people with the pain point tell us where we should be investing our money.
Okay, to the audience, any questions here? So I don't see anything coming on the app. Wow, nobody wants to grill VCs, wow. Oh, okay, let's start here. There's mics here too, if you can just...
Sure. I guess I'll be loud enough.
Oh, good.
My name is Veena Srimani. I work for IBM in Asia. And how do I get foot in the door and really convince people?
So basically, your question is, how do you approach a VC and get to them so that at least they consider your startup?
Also, it sounded like you guys are very special in certain areas where people like us don't even understand the game and figure out who are the right VC to approach.
So you don't understand which VC to go to for money?
Yes.
Okay, that's a different problem. Okay. So let's start with, let's make it more generic too. How do we approach a VC? You guys have tons of deals. You have lots of folks who come to you through connections. How does somebody who maybe doesn't know you as well, how does he approach you, and do you even consider those deals?
So the best way is to find a warm introduction. That has been said several times, and I think is largely true. Now, I think, look, the reality is, if you don't know somebody uncommon, it is on to you to find a way to work. And I think brute force, personally, I believe brute force is a way to make it work. And so, first of all, don't be shy in cold emailing or reaching out to somebody at a conference and stuff. The thing I'd say is target the person a little bit. So if you're starting an application company in the enterprise world, reaching out to my partner who focuses on consumer or even enterprise infrastructure is not going, like it is only reducing your already low odds of getting a response through a cold email, right? So I would target, and even within that targeting, you should look at, look, if I'm starting a gaming company, who in the consumer world has been investing in gaming for the last 3 years? They've already shown an interest in that. Or who were some of the VCs who were earlier gaming execs? So some things like that, you need to find a correlation. And then I would even say, make the email a little more personalized. Like sometimes I get cold emails where the font is different. The email is there and my name is clearly a cut and paste. And then, and this happens, right?
Sometimes your name is not there.
Sometimes my name is not there. So it starts with dear sir.
Yeah.
And I think these are basics, and maybe I'm getting too tactical here, but the reality is I see this every day. And so I'd say the better chance is if you do a little more personalized and be a little more thoughtful about the cold reach out.
Yeah, I don't mind the cold reach out, only because I've been running this experiment for several years to see if I can actually reply to every single email and try to help. And
How's that going?
so when I get busy, I'm not as good at it. But maybe in one sentence or two, when something is not a fit, I try to tell them why. And often the answer is I don't focus on this area, as you were saying. The reason I started paying attention to the cold emails is I know that all the other VCs prefer warm introductions. So I thought maybe by actually reading these emails, maybe I can find that one special entrepreneur that doesn't know anybody and can't get the warm intro. But I haven't tracked how successful that's been. But yeah, I do read them, and in fact, it can be more efficient. Like, for example, what happens at conferences like this is often, you meet a lot of people, and you can't, you don't remember exactly what all the ideas were and who matches up with which idea, and so you can't really follow up. So I'd rather get emails. My email address is salil@baincapital.com, and rather than conversations that I won't remember, I'd rather get the email so I can be organized.
But I would say that the best approach is have the VC reach out to you. So you have to basically figure out a way to create, you bootstrap your company, right? Because if you try, the first thing should be that you go raise some money or whatever, friends and family, and get that done. And then if you get a product done, people will figure out and will reach out to you. Because that's the best thing to do, because then there is intent for somebody to do something with you because they've already studied what you're doing or have figured out somehow that what you're doing is there of interest. And you don't have to do that pitch. So a lot of best entrepreneurs figure out a way to get the VCs to talk to them rather than the other way around, right?
Okay, anybody else? I saw some other hands go up, so yeah.
Oh, I'm right here on the
Okay.
mic, so
Please.
sorry.
Oh, that's fantastic. Thank you.
Waiting a long time. All right, so I'm a first-time entrepreneur, and I have a question for the VCs on the panel that invest in early stage. So it's interesting that you guys mentioned that you do invest in seed, because I've been told that you shouldn't go to a VC, you should go to an angel. So what is your opinion on that? And my second question is, have you, any of you, invested in B Corps, and what do you guys think about B Corps?
Want to take that?
We do seeds. We don't do many. We're not as prolific as seed funds. We didn't do any before I joined the firm. Then I put in place a seed program, and we've done about a dozen in the last 2 years or so. I've done 6 or 7. One of my partners has done 2 or 3, and then a collection of other partners have done another 2 or 3. If I had my druthers, we would have done twice as many, because the program I put in place is a particular kind of seed program designed to run a particular kind of experiments that will yield certain results, so we can know whether it's a real deal or not at the end of it. And it's MDs in their domain expertise. All our MDs are sector focused, so it has to be a seed that a particular MD is sponsoring in his domain. Various other restrictions. But it's working out really well for us. But we're not. That's a dozen seeds in 2 years, whereas seed funds and other angel investors will have done 2,000 of them by now.
Yeah. I do seed investments. I did 3 seed investments last year, just myself, and I think across the firm we did probably 20. So the way I think about it from an entrepreneur's point of view, there are a couple of reasons why people say don't go to the large VC. One is the often talked about signaling risk, that if it's a primarily Series A VC, they do the seed, but they don't follow on in the Series A. Is this a negative signal to the market? And then the rest of the VC world will also pass as to, why is Nakul not doing it? Does he know something that I don't? And stuff like that, right? I think the reality is, the market is so competitive today that even if I do the seed round, I am not assured that if it will be a good company, that I can actually get the Series A. So I think the signaling risk is overblown, and it's a good blog post content thing. But the reality is, if you have a good company, your seed VC will be hustling as much as some outsider to get money into the Series A. If it's not working out, then they will pass, but the rest of the market will pass. The challenge is when there's some signal, but not enough, and some confusion. But I will tell you, like, we've been in seed deals where we were preempted by an outsider and we couldn't do the Series A. And yet, in cases where we wanted to do the Series A, so that's one case. And there were other cases where we were the seed investor. A year in, when the Series A came up, we didn't want to lead because we couldn't feel confident, and yet another VC did it. So I think it's an overblown thing, and I would just reach out.
Thanks. I think we're running short on time. Maybe one last question, but very brief, and just probably one guy could answer it. Yeah.
Yeah, sure. So within the infrastructure space, what are some of the pain points or white spaces you see where you may be interested in investing?
That's a long answer. Gosh, it's very specific, but containers are becoming the deployment unit of software, so that's changing a lot of things. There are always new architectural patterns happening, microservices, so that's enabling a lot of platforms. In-memory databases, NoSQL databases and in-memory databases are happening. I'm invested in a couple of them. And in general, the whole stack gets rewritten every 15 years or so. Every single piece gets rewritten. So I think there's really opportunity everywhere.
Okay. All right. Thank you so much. I really appreciate your time. I think you guys left them off pretty lightly, but you still can kind of talk to them. They're here. They're there for a few more minutes. So thank you again, everybody. Appreciate it.
Thanks.